Hi everyone, welcome back to the video. So today we're going to be going into the 5 accounts that you need to set yourself up for success on your journey to financial freedom or independence. And these are just very general accounts that you may need, and some of them are only offered if you have a W-2 job or they're offered by your employer. So yeah, stay tuned. So let's get right into it. The first account is the high yield savings account, and this is probably the most important if you intend on reaching financial independence early or, within the next, I would say 8 to 10 years. So if you want to retire early within the next 8 to 10 years, you're going to need to increase your savings rate by a lot over time. So if you want to retire 22 and you want to retire by the time you're 30, you'll need to save at least 70 to 75% of your income, if not more. So if you're not there yet, or you're a little bit older, to start, it's recommended, and this is just a rule of thumb, to save 20% of your income and then increase as the years go on. Now, in terms of which account to open, you can do a simple Google search, search high yield savings accounts to open, and you'll get a bunch of articles like saying the pros and the cons and the benefits of the different banks. I have Ally and SoFi right now, and I'll get into why I have two in a little bit. Yeah, I really like them. The interest rates are really great, and the one thing that I think is very important is that in the account, you're going to want to open different buckets, or they're called sinking funds, in the account to help you optimize your savings even more. And then this is the fun part. So after you save your 3 to 6 months of expenses, you're going to want to save for whatever you want, essentially, depending on if you need the money in the short term or long term. For example, I have 3 different buckets. I have one to save for a down payment on a house, I have one for travel, and then I have one that I call splurge, which is where I save for, any gifts that I want to buy myself or for somebody else. I don't know, like a nice piece of furniture, or something that that I want but costs a little bit of money. So I'd rather save for it over time, and then if I still want it, I'll use my splurge account to pay for it. And of course, these are going to look different for everyone. So yeah, use these buckets to save for whatever you want, whether that be, car, wedding, travel, even going out to eat, like your pet even, you can save. So this is really up to you, and this is kind of the fun part. But again, make sure overall you're contributing, starting with 20, if you can manage that. So you can start with less or more, but just know that the end goal, if you want to retire early, is to get to that 70-75% savings rate. So this is a little bonus section, but I mentioned this before, that I have 2 high yield savings accounts with Ally and SoFi. This video isn't sponsored or anything. But I do something called bank account churning, where I open different bank accounts to get their sign-up bonuses. And it requires, a little bit of effort. You gotta open the account online and then contribute some money into it, like an opening, deposit, and then set up a direct deposit to the bank account and then wait for the bonus. So this is it's much easier to do if you have a W-2 job and you have a payroll system that allows you to contribute or add in multiple bank accounts. I'm lucky enough that I do. So right now I have 3 or 4 different ones plus my checking account. So real quickly, I just go through what I do in my criteria. So you can do a quick Google search. Maybe I might leave a link or something in the description, but if you just search savings account bonuses and then the year, so 2023, and some people will literally have the list of banks plus the bonus amount. So I did that at the end of 2022, and I only opened up banks that had more than $100, and something that was the criteria had to be super low. If I can contribute $500 a month and get an extra $200, then to me that was worth it. So basically, I spent a lot of time going through the banks, and right now I have my 2 base accounts, like I said, Ally and SoFi, and then I'm also churning with Chase Bank, Citizens, and Alliant, which is a credit union. Also look up credit unions too. They do these things sometimes too. So if I open these banks, and I'm contributing the same base amount per month into my savings, but then within that amount, I'm divvying up that money to the different banks. So by the end of, it's January right now, so by the end of March, I'll have like an extra $900, I think, just from saving that 20% of my income and then opening these different bank accounts. So definitely a good way to earn some extra income. It's really like you're not really doing that much work and it doesn't take that much time or energy. And I think it's a great way to just boost your savings even more. Okay, moving on to the next one. So the next account is a workplace sponsored retirement plan. This is going to differ depending on where you work. You have a 401k, 403b, 457. There's a bunch of different ones. So whatever they offer you, just make sure you open it. Open it, contribute the highest or whatever percentage they specify so that they will match whatever funds you put in there. And this is important because it's essentially free money. And I'm doing quotes because it's not really free money, and I'll get into that in a second. But yeah, contribute whatever is high enough to get the match. And I'm not sure, you'll have to Google like the different contribution limits. I know for a 401k, as of 2023, you can only contribute $22,500 if I'm not mistaken. That is a lot of money, and not everyone is going to want to contribute that much to max it out for depending on how much you get paid. But that's what I'm saying. Just contribute what your company will match you. It doesn't have to be the maximum amount to hit that 22K number. Okay, so back to the free money point. So the money that you contribute and that your employer contributes is all great at first, but you need to be aware of your company's vesting schedule, which basically determines how much of that money you actually own. Because even though you and your company are both contributing, you might not own the total sum of that money. So your vesting schedule will look different, obviously, so ask your employer. I've been at companies where they had a 4-year vesting schedule, so after your first year of working there, you're vested 25%, 50, 75, 100. I've been at companies that had 3-year vesting schedules, so 33, 66, 99/100. So yeah, make sure you look that up. It's basically just an incentive for you to stay at the company longer. So one good benefit with these is that after a certain amount of time, you can actually take out a loan on that money, and you can use that towards the down payment on a house, any type of home repairs or anything like that. Any big purchases, whether you have a child or moving, whatever, you can use that money for whatever you want because it's your money. And just lastly, I know that they do the vesting schedules to kind of incentivize you to stay with the company, but don't feel like you have to stay there if you're not happy or if you have a better opportunity. So the next account on my list is an HSA or a health savings account. Now this option is only available to you if you are enrolled in a high deductible health plan. So if you're working for a company and they do not offer an HDHP or high deductible health plan, then you can't open this account, unfortunately. But if you have that option, definitely do it because it has some great tax advantages. The one caveat, or the one thing I would say is that if you're relatively young and healthy, you don't have any major health issues, then definitely give this account a try. 2 years. So the money that you put into the account is tax deductible, so it's pre-taxed, and then you can invest that money. It grows tax-free, and then the withdrawals you make that are tax-free as well. But this is a health savings account, so you can only use this money on qualified medical expenses, whatever the IRS defines as a medical expense. So again, this is good to have now so that you can invest. It'll grow over time, and then when you're older, inevitably health problems are going to come up, and you will have, hopefully 5-6 figures of money to pull from to pay for whatever you need to pay for, and you can use it obviously on your family members, and also yourself. So definitely a great option. One con that I would say, well, there's other cons too, but the big con is that it's linked to a high deductible health plan. So high deductible in this case means like 5 to 7K that you have to pay out of pocket before the plan starts covering you. So again, that's why I said if you are going to be at the doctor a lot, then this might not be a good option for you, depending on how, if you're very cash poor, for example, 5 to 7K is pretty steep to pay on just, doctor's visits alone. So that's the one thing that you have to have a high deductible health plan. Otherwise, definitely a great idea to open. There is a contribution limit. As of 2023, when I'm recording this, the limit is $3,850, but there is no income limit. So you can make, be making multiple six figures at your job. You can still contribute to it as long as you're enrolled, again, in the high deductible health plan, but you can only contribute around $3,800 for the year. Okay, so the next type of account is the Roth IRA. IRA standing for Individual Retirement Account, if I'm not mistaken. And this is my favorite type of account because of its flexibility and its benefits. So you don't need an employer to open this account. Some of them do offer it. You can open it through them, but you don't absolutely need one to do so. So the contributions are tax-free. So you're putting cold hard cash into it. The money's already taxed, so you don't have to worry about that. So the contributions are tax-free. The capital gains are tax-free. So you invest the money into ETFs, mutual funds, index funds, whatever you want. And then the withdrawals are tax-free as well. But there's a big asterisk here that I'm going to expand on in case you want to withdraw your money early, quote unquote, or if you need the money in the mid to long term. So the general rule is that you cannot withdraw the money before age 59 and a half because it's still a retirement account. They want to encourage you to save for retirement. So if you're before age 59 and a half, you can't necessarily pull out money. But again, big asterisk, and I'm going to get into some of the reasons why, and also one big benefit that I think is great for someone on their FIRE journey specifically. So first I'm going to go through some basics of the account. So again, retirement account, you can only contribute $6,500 in the year. Now, this is important to know. So I'm just going to use the year that I'm recording this. So 2023. So the contribution limit is $6,500. So January 1st, 2023, you can contribute $6,500 to your Roth IRA and just be done. That's it. You don't have to worry about it anymore. But if you want to space the contributions out, you have to remember that the deadline to do so isn't until April 15th of the following year. So you can contribute to the account from January 1st, 2023 until April 15th or whatever the tax filing deadline is, April 15th of 2024. So you have more than 1 year to contribute to the 2023 $6,500 balance. So keep that in mind when you're calculating how much to contribute each month. Okay, another thing, or like a basic benefit of this that I don't know if people know, but that is that you can withdraw that $6,500 at any time, prior to being 59 and a half years old. So because that money was already taxed, it's technically just cash, so you can just pull it back out if you need it. You can't obviously pull out the gains on that, only the $6,500. But again, if you, put the $6,500 January 1st, and let's say you need $3,000 for whatever reason, in October or later on in the year, you can just pull that money out, no problem. But you might have to pay an early withdrawal penalty. And that might contradict what I said earlier, but yes, you might have to pay an early withdrawal penalty on that because you're still not 59 and a half yet. Okay, and lastly, there's something called the 5-year rule that applies to the Roth. Okay, my battery died, but I'm back. So I think this is where we left off, but the third thing is the 5-year rule, which means that once you open your Roth IRA after 5 years, you can withdraw money, including your earnings. So what do I mean by earnings? The money that you contributed and invested, the earnings that you made on that, for example. So your capital gain. So you can withdraw that money tax-free, but you have to pay a penalty because you're still before, again, 59 and a half. Now, that's the 5-year rule. So the one exception, and again, there are a few exceptions that I'm not going to talk about all of them, but I'll leave some links. So the one exception that I think is attractive to people on their FIRE journey, or if you're interested in real estate or just different investments or anything like that, is that you can withdraw up to $10,000 to pay for a first-time home purchase. So if you contribute $6,500, again, you can withdraw that. But this is including now any earnings or capital gains, dividends that you got, you can pull that out of your Roth IRA. And because this falls within the 5-year rule, you won't pay a penalty, but you might have to pay taxes. The Roth IRA, and also there are income limits, like a lot of these have. So I'm pretty sure as a single in 2023, the limit is like 153K. So if you're a higher income earner, if you make more than that, you won't be able to contribute to a Roth IRA. So the last type of account on this list is the taxable brokerage account. This is my second favorite type of account. So you don't need an employer to open this. You can contribute however much you want and invest it how you want. Now, there are a lot of brokerages out there, so there's a ton of videos on YouTube comparing which one to which one and the pros and cons of each of them. So I would say do your research, open whichever ones you want. I use M1 Finance and TD Ameritrade, which I think is actually becoming a Charles Schwab account. But anyway, I'm using those. I really like them. I think the user interface is great. It's relatively easy to use and invest, especially M1. I'll leave a referral link for M1 if you're interested in opening an M1 account. But yeah, it's really good. I've also used Robinhood in the past. I think I started with Robinhood back in 2018. I've used TradeStation, which is another good account. Also, don't feel like you need to open just one. I have two. I've had 3, 4. And you can close them at no, there's no penalty. There's no like ding that you get. So feel free to open, 1 or 2 if you want to. You don't need to open just one. You can enjoy the benefits and the pros of all these different types of accounts. So, as the name suggests, this is a taxable brokerage account, meaning that if you withdraw your money or sell any of your positions, they're going to be taxed. Now, there's unrealized and realized gains. So starting with unrealized, if you put money into your account and you invest it and, the stock goes up, that money that you gain, called it capital gains, as long as you don't sell that stock or share or position, it's called an unrealized gain, and those cannot be taxed because you're still holding that position. Now, if you invest in a stock, let's use Amazon as an example. You say you buy Amazon stock January 1st, and then March 31st, it, goes up 20%, and you want to benefit from that gain. You can sell the stock, and that turns into a realized gain, and that is going to be taxed, and that's going to show up on your tax forms the following year. So the best way to I don't want to say best, but one way to build your wealth is to just buy stocks using dollar cost averaging. I'm not going to get into that, but I'm sure you've heard of it. Dollar cost averaging, have your portfolio go up, and just do not touch the stocks, don't sell. Don't do anything. You can rebalance your portfolio every once in a while. You just want to benefit from the gains, the unrealized gains, until you're ready to retire, and then you can do some harvesting and just benefit from the dividends and again the capital gains from the positions that you held. So yeah, again, this is a great account to have. I would say this is even a must-have if you want to grow your wealth. So that's the end of the video. Thank you guys for watching. If you are like me, if you're a lurker, you don't really comment on videos, if you could just like this video and let me know if this was helpful to you, that would be helpful to me, because then I know that you're watching it and you find some type of value for this. So yeah, thanks for watching. Bye.